Hello, and thank you for tuning in. Today, we will be focusing on employee stock options. This presentation is brought to you by the California Society of CPAs. My name is Darrell Young, and I'm a volunteer board member and the chair of the Financial Literacy Committee for the Peninsula Silicon Valley chapter of CalCPA. I operate a wealth management practice in the San Francisco Bay Area. We intend for this presentation to be interesting and informative. The data points contained herein are believed to be current. Please note, however, that this presentation is intended to convey general information, which may not be applicable to your personal situation. Please do not interpret the information here as advice for your personal circumstances. You should consult with your personal advisor, or certainly feel free to give my office a call. Now, as already mentioned, today's agenda will focus on employee stock options. There's a lot of material to cover in a fairly short amount of time. Please understand that it's certainly not going to make you an expert in the subject matter, but we do hope to touch upon the high points of employee stock options. You see there our agenda on the left-hand side. We're going to look at terminology, different types of stock options. For the purposes of this presentation, we're going to focus on non-qualified stock options or non-statutory. We'll look at vestings, expiration. We will look at sample transaction. But before we do all that, I'd like to review with you what we believe to be the cornerstones for financial success. Those being planning in accordance with your goals and your risk factors, giving back to your community, working with people whom you respect and trust, and maintaining a positive attitude and competitive awareness at all times. It is our belief that if you are maintaining these behaviors, that you have the makings for financial success. Time is our most precious resource. There are no shortcuts to financial success. So what exactly is an employee stock option? And again, we're focusing for the purposes of this presentation on the non-qualified version of stock options. There at the bottom, you see the definition. It allows an employee or an optionee to purchase a specified number of shares within a specified period of time at a specified price. And that is all determined in the award grant. Just as a side note, in our US population, it's estimated that about 9 million employees participate in these types of award arrangements. With some background, I'd say that stock options have been around for decades, had been traditionally awarded to top management, and in more modern days, you may see that stock options are not just awarded to top executives, but also to employees and even sometimes to contractors. Needless to say, they are awarded as a form of compensation and ideally would align the interests of the employee with the company and other shareholders. Some terminology that you may have come across before. Strike price or option price is the price at which the employee can purchase the stock or the shares. The word exercise itself is just a fancy word for purchase. And we're going to focus on exercising and selling because in my experience, 90% of the time, that is what employees do. And we're going to take a look at an example of that. Expiration date, of course, is the last day that action can be taken, and the spread or the gain is the difference between the fair market value of the stock and the strike price or the option price. A few brief notes on administration. Typically, stock options need to be formally accepted as part of a compensation contract, so think of it like any other contract that needs to be signed and countersigned by both sides. Usually, a brokerage account must be set up in order for you to be able to transact, and in this case, ideally to be able to sell shares from options that you've exercised. Stock options are typically non-transferable. So say, for example, if you are an employee at a company and you're awarded stock options, you couldn't, for example, transfer those stock options to your spouse or to your children. Again, generally they're non-transferable. Termination from the company usually means that you cease vesting at that point, although you may be able to exercise any options that are already vested, and you'll be given a designated time period to do that. Types of stock options. So again, for the purposes of this presentation, we're going to be focusing on non-qualified stock options, or sometimes non-statutory stock options. You see there the reference to the IRS publication on the left, and that particular document provides a wealth of information with respect to all different types of employee compensation, stock options just being one type. If you have difficulty determining what type of stock option you have, obviously it should be stated in your award agreement, and that IRS document also provides distinguishing factors in case you need further help in determining which one that you have. Now, in contrast to non-qualified stock options, you may have also heard the term incentive stock options. I think the key difference there is that incentive stock options offer a little bit of a tax advantage. So as you might see there, at the time of exercise, which again is a fancy word for purchase, no ordinary income tax is due, and that's assuming that a simultaneous sale of the shares did not occur. However, note that the alternative minimum tax, or the AMT, may apply. How does vesting typically work? So of course, vesting is the amount of time that needs to lapse before the options essentially are seasoned and the employee can take action on them. You see there a couple of different methodologies. I suppose the most common one is the gradual vesting. So in this case, example number 1, you see how the employee has been granted 4,000 options, and those options vest 1/4 each year over a 4-year stretch. And this does not necessarily mean that the employee needs to wait all 4 years in order to be able to exercise and sell. After the first year, the employee might be able to go ahead and exercise and sell 1,000 options, again, as they vest. Typically, an expiration date is also attached to the award grant. It could be 7 years, it could be 10 years, and exactly as the name indicates, it is the last date on which the employee can do something with the options. Be mindful, however, if your expiration date happens to fall on a weekend or on a holiday, because then the actual expiration date would be the prior business day of stock trading. Trading windows. Now, as an employee of a company who has been awarded options, does this mean that you can exercise and sell at any point of time? Not necessarily. Perhaps you're designated as an insider at the company, and in such case, perhaps you are subject to blackouts. And so you see here, as the graph indicates, this particular person might only be able to exercise and sell options in trading windows. And oftentimes, I would say that those trading windows are in conjunction or in association with earnings announcements and other periods where material inside information has been released to the public. Let's look at an example. So again, we're looking at non-qualified stock options. In my experience, I would say that 90% of the time, this is what you would see. An employee exercising, again, purchasing shares from an option grant, and then simultaneously selling those shares on the market. To put some numbers to the example, let's say that the option price of the strike price was $5, and the person is able to sell those shares on the open market for $25. Exercise and sell date, well, we're assuming it's going to be February 20th, and the quantity of shares in this case, 1,000 shares. And because it's a sell transaction, note that the brokerage firm is levying a 5 cents per share fee on the transaction. So what does that mean? On the right-hand side, notice that we have a calculation for taxes being withheld. And again, this is a non-qualified option transaction. So if we say that the sale price on the date of the exercise and sell is $25 and the option price is $5, that means that the employee is gaining $20 per share. And again, we're looking at an example of 1,000 shares, which means that the gain in this case is $20,000. So if we assume federal taxes at 25%, California state at 9.3, etc., what you see there is that the total withholding on the transaction is $8,570. So down there at the bottom, here's the end result. If I, as the employee, sold 1,000 shares on the market at $25 per share, I took in $25,000 gross. Minus out from that the $5,000, which is my option price, is my purchase price. Minus from that as well the $85.70, because that is the tax withholding being applied. And then minus out the $50 because I am taking my 1,000 shares and selling them, and the broker is charging me a $50 commission. So the amount that comes net to me is the $11,380. Now, are you all done with taxes at this point? Well, I would view this in the same way that you view, say, for example, the W-2 from your company, where you've been subject to a withholding, but you'll true up with Uncle Sam at the end of the year, or on the April 15th deadline, in other words. Now, instead, let's say that this employee had decided to hold the shares instead of sell them. So you see here that the facts are virtually identical. The only thing that's really missing is the 5 cents per share commission on the sale, because there is no sale. The employee in this case is electing to hold the shares. The tax withholding is the same. And so rather than the employee taking in proceeds, the employee is going to pay the $5,000, which is the purchase price or the option price, is going to also pay the $85.70, which is the tax withholding, and that is the cost to exercise. What does the employee walk away with in the end of this? 1,000 shares of the stock. And the date of the exercise will become the start of the holding period for either capital gains or losses, depending on the direction of the stock price from here on out. Now, getting further assistance. I know that we've covered a lot. What role can your financial advisor play? Well, certainly to the employer, to the company, financial advisors like myself can help to provide a platform through which stock options can be exercised and sold. We also hope to provide educational opportunities to the people who have been granted stock options. To the individual employees on a one-on-one level, a financial advisor like myself can also help to manage positions, provide advice and guidance within the framework of a holistic financial plan. So again, my role as a financial advisor, I can interface on both levels with the company and also with the individual employees. For future reference, we hope to cover other topics related to what we've covered here. So incentive stock options, we didn't spend really any time there. Restricted stock awards, perhaps you've heard the term before. Stock purchase plans, 10b5-1 trading plans, and also early exercise elections. There's plenty of other ground for us to cover in the arena of employee stock compensation. It's a lot more complicated than you might think. With that said, I'd like to thank you again for your attention. My name is Darrell Young. I hope you found this presentation to be informative and interesting. I welcome your comments. Thank you for listening.